finally have got weekly US oil inventory data after a glitch delayed or postponed publishing of those crucial numbers last week. Here to make sense of the numbers, Jason Schenker, President at Prestige Economics. Jason, it's great to talk to you. One number I'd love you to explore with us. Apparently the oil inventories at Cushing, Oklahoma, where the futures are based, have fallen to their lowest since 2014. Is that a sign of a very tight US oil market?
Well, not necessarily. I mean, I think there are a lot of data here that point to a very tight U.S. oil market. The Cushing inventories often get overbuilt because there isn't enough room for the oil to move around. If we see Cushing inventories going down, that may simply be because you don't have as much oil stuck there, something that has happened in the past. And the reason the oil is able to flow a bit more through the system is because in general, inventories are down and demand is very high. Oil's flowing around everywhere at this point.
Where is oil going? Is it staying above $100 for now because of this tight, or maybe I should say uncertainty over the supply situation? It's still not clear how much oil Russia is going to be able to ship out.
Yeah, I remember we talked about this just a few weeks ago, and I thought we'd see spikes in the summer between 120, 125. We've seen those kinds of prices already, and now prices come back down. There's going to be a push and pull between the driving demand that's very strong and the revenge travel piece, the fact that inventories are tight, and even though production in the U.S. is up, it's still off the peak levels we had seen back in 2020. Those are bullish dynamics. Against that, you have a very quickly slowing economic situation in the United States, in Europe, globally, and you've got that prospect of higher interest rates, stronger dollar, higher bond yields. All of those things are going to put very quick downward pressure on the global economy, likely to result in demand destruction in the fall.
In the fall, but you would see pretty decent demand right through. Revenge travel, people desperate to get on the roads.
Oh, that's right. They're desperate to get on the roads and the planes. No matter what, they're looking to get out there right now. You can see that in a lot of the data. You go to any airport, they're pretty packed. People are out there really traveling in large numbers. But once we get through that summer travel season, we move into what's called the shoulder period. We get weaker demand in the fall. And that's where at exactly the same time where the summer travel season kind of falls off, you're also going to be getting much slower business investment and the increased probability of recession as we see that U.S. consumer confidence just really taking a beating.
The fuel situation is fascinating, isn't it? I mean, fuel is trading as though oil, or has been trading as though oil prices were much higher because of refining bottlenecks, among other things.
Well, that's right. And if we look at some of the data where we are, the motor gasoline, those inventories, those are down significantly year on year. That's where we see that strong demand. That's where the inventories are tight. And at the same time, we also see that's where that demand pull is coming from faster than even refineries can crank out the product. So this is where that summer driving demand in the U.S. and the revenge travel, that's really pulling that end piece on the demand side. Really price supportive right now, as is the fact that the SPR has been run down. So there's sort of less of an emergency cushion. But those bullish factors may be little solace if we find ourselves sliding into a significant recession, something that risk is underscored today by the fact that Q1 GDP revised down lower for the U.S. to minus 1.6%.
Our Bloomberg partners are reporting that there's a massive rush to hedge fuel costs in the United States. Companies that use a lot of fuel, such as Disney or big retailers. What effect does that have? I suppose it means that future supplies are being tied up at a fixed price.
Well, if you're a consumer and you're locking in your price, that's actually a bit price supportive, right? Because they're trying to lock that price in before it goes higher. They'll usually, they're going to typically pay a little bit of a premium over what's now if they're locking it in the future. But if you're a producer, you want to lock it in before it could potentially go lower. And so you might, that's something that can push the price down because you're trying to hedge against the downside. But those if we are going to see more hedging from consumers at this point, that's a bit more price supportive. But as we see the economy beginning to slow, just as production's going up, as rig counts are up, you're going to potentially get later in the year this storm of finally more supply, finally more production, just as growth really suddenly slows quickly.
Isn't that always the way in commodities? There's a boom, they build big new capacity, but the boom is over by the time it comes online.
Well, that's right. I'm sure you've heard the wildcatter's prayer, right? Which is, just give me one more oil boom and I won't blow it this time, I swear, right? And that's, we get that, high prices cure high prices dynamic happens every time.